Right now, a single 21-mile wide strip of water carries the weight of the entire global economy on its shoulders. If this passage closes for even a week, oil prices wouldn't just rise, they would explode, potentially triggering a global recession overnight. This is the Strait of Hormuz, and for investors, it is the most dangerous and important geographical feature on the planet. Welcome back to Market Maneuvers. Today, we're diving deep into the geography of global crisis. While many focus on stock charts and earnings calls, the real maneuvers often happen in the narrow shipping lanes of the Middle East. The Strait of Hormuz is the ultimate choke point, a term used by energy analysts to describe a narrow channel along widely used global sea routes that is critical to energy security. By the end of this video, you will understand the staggering volume of oil that flows through this strait, why the escalating tensions between the US and Iran put your portfolio at risk, and exactly how the market reacts when the choke point begins to tighten. Let's break down the world's most critical oil artery. To understand the risk, we first have to understand the scale. The Strait of Hormuz connects the Persian Gulf with the Gulf of Oman and the Arabian Sea. At its narrowest point, the shipping lanes are only 2 miles wide in either direction. Yet through this tiny gap flows roughly 20.5 million barrels of oil every single day. That is more than 20% of the world's total liquid petroleum consumption. It's not just crude oil. About 20% of the world's liquefied natural gas, LNG, also passes through here. For countries like Japan, South Korea, and China, this is their literal lifeblood. If you are an investor in global energy, you aren't just betting on companies, you are betting on the continued openness of this specific waterway. History tells us that this isn't just a theoretical threat. During the Iran-Iraq War in the 1980s, both sides attempted to disrupt the other's oil exports in what became known as the Tanker War. Hundreds of vessels were attacked, and the U.S. Navy eventually had to intervene to escort tankers. For investors, this period serves as a grim blueprint for market volatility. Whenever a tanker is harassed or a drone is downed in this region today, the market remembers the 80s. Risk premiums are instantly added to oil futures. Even without a full blockade, the mere threat of conflict drives up insurance costs for shipping, which eventually trickles down to the price at the pump and the inflation data that dictates Federal Reserve policy. Why is the threat higher now? Because the strait is the ultimate geopolitical lever. Iran has repeatedly suggested it could close the strait if its own oil exports are blocked by international sanctions. This creates a high-stakes game of market maneuvers between Tehran and Washington. For the U.S., keeping the strait open is a matter of global national security. For Iran, the ability to threaten the strait is their greatest deterrent against further escalation. As an investor, you need to watch the rhetoric coming out of both capitals. A shift in diplomatic tone can move oil prices faster than any production report from OPEC+. So, how should you position your portfolio? When tensions rise in the strait, we see a predictable pattern. First, Brent and WTI crude futures spike. Second, traditional safe havens like gold and the US dollar often catch a bid as investors flee uncertainty. But there's a third, more subtle move: the impact on shipping stocks and energy infrastructure. A blockade would be catastrophic, but the friction leading up to it creates trading opportunities. Volatility is the new normal in the energy transition era. While we move toward green energy, the world's reliance on these specific barrels remains absolute. If you're not tracking the Strait of Hormuz, you're trading with one eye closed. You might ask, can't we just go around it? There are pipelines, like the Habshan-Fujairah pipeline in the UAE or the East-West pipeline in Saudi Arabia, that can bypass the strait. However, their combined capacity is only a fraction of what moves by sea. There is currently no infrastructure on Earth capable of fully replacing the Strait of Hormuz. The Strait of Hormuz isn't just a geographical feature, it's a financial trigger. If you found this breakdown helpful for your investing strategy, make sure to hit that like button and subscribe to Market Maneuvers. We're tracking these global flashpoints daily so you can stay ahead of the curve question for the comments. Do you think the world is too dependent on this single choke point, Or will the energy transition make the Strait of Hormuz irrelevant in our lifetime? Let me know your thoughts, Belly. I read every single one.